Today, we're going to talk about a technology that fascinates as much as it divides: direct air capture. Some see it as an essential building block to reach net zero. Others think it's an expensive distraction that delays real emissions reduction. To find out, I'm sitting down with Thor Gutierrez, former Tesla engineer, now building Europe's leading direct air capture company at Sirona. Before we start, I'd like to say thank you to EXA and their Climate Acceleration Program for having us in their studio. Reach out to Maxime Bruce if you want to learn more. When we think about trying to remove CO2 out of the air, we want to do it now in countries or places where basically the concentration is like what's in the atmosphere, which is like 420 parts per million. Why not going after what's the extraction point or the production point, which is the factories and everything, right?
Yeah, good question. I mean, I don't know if you've seen that meme where it's like, we didn't do this because it was easy. We did it because we thought it was easy, kind of thing, right? That's the joke. But for real, when you think about climate change, which is, that's the mission we have, right? We're there to solve climate change. Number one is you need to reduce emissions. That's what everybody's doing with EVs, with renewable energy, and also with carbon capture, where you're capturing CO2 at a point source of emission. But we also know we won't be able to reduce emissions to zero. There's always going to be a long tail of emissions, residual emissions, and we're going to have to compensate for those. And so that's the second thing we need to do is we need to compensate for residual emissions so that we can get to net zero, right? That's the net zero. And you can do that with trees, right? And we can also do it with machines, and that's what we do. So the key insight is that we're not going to be able to reduce emissions everywhere, or we're not going to be able to put a carbon capture filter on every source of CO2 emissions, right? And so for all of these diffuse emissions, we'll need to remove it from the air.
But is that the best use of capital and engineering resources that we have today? Because if I think about it, I'm like, even in the best case scenario, how much can you remove? Maybe 1%, 2%, I don't know. Maybe more, you'll tell me.
Yeah.
But like, I'm also thinking like we should maybe prioritize going after reduction right now.
Yeah. So again, let's look at the big picture. So today in the world, we emit 40 gigatons of CO2 in the air. That's 40 billion tons of CO2, right? All the scenarios you see in the IPCC and all of that, if we do a really, really good job, we reduce our emissions by 75% by 2050. That means we go from 40 to 10. But 10 gigatons, that's the residual emissions, 25% of the problems. So we need to compensate for those. That problem is actually massive. But it's also something we have to do in 2050. We don't have to do it right now. So you're totally right. That's priority number one for the whole world is reducing emissions. But given how large is the volume of emissions we'll need to remove from the air per year, we need to start scaling right now. Basically, even if we were following the most aggressive scaling curves like we see for solar or wind, we need to do the same thing for DAC, for example, which is nuts. And so if we wait 10 more years, we'll never get to the volumes we need.
So do you think you're ahead of time?
I think we're at the right time, basically. Like we have to start now. It's the right time. But I agree that it shouldn't be that all the capital goes to carbon removal or direct air capture. It should probably sit at like 1 or 2% of all capital invested in climate. And I think that's where we are today. So it's actually pretty good. But it's much more present in the VC world because there's a massive opportunity for them, right? This market is going to be one of the biggest ever. It's going to be as big as oil and gas. And so they want to get in early. So they see like the share of capital allocated to different industries is going to be ahead of its time at the VC level of the stack. And then we just have to look at the whole picture where all of the capital stack above is not going to DAC yet.
All right, let's talk about that because, I've spent time working for Microsoft, which is one of the biggest purchaser of credits today. I still haven't fully formed my conviction that people are going to pay for it. So you say it's going to be a massive market. Who's going to
Yeah.
pay for it, according to you?
Yeah. Yeah. What is the demand driver?
All right.
Yeah. So there are really two markets to look at. One is the voluntary carbon market, and one is the compliance market. And today it's mostly voluntary carbon market. It's kind of like the bootloader for us to get to the compliance market. And it's really great because there's a lot of companies out there who are actually really willing to pay a high price for these credits, like a big premium. Like you said, Microsoft is a great example. But I think today there's about 700 customers who are buying durable carbon removal credits. And they're paying a high price compared to the traditional old carbon credits. Um, Total contracted value in our industry now is $12 billion. So it's huge, right?
Lifetime, right? Like from the start of the industry through today,
Yeah,
it's
exactly. Cumulative contract signed for durable carbon removal is $12 billion, which is a huge industry already, which is great because it allows us to get started and to reduce cost, right? What's also really great about this market is that everybody's learning. So the science is learning, the registries are learning. We are understanding what is a carbon removal that you can trust and what is one that you can't. How much does it cost? How we should certify this? And these are all things that the compliance market can learn from. And so, for example, right now, Europe is very, very busy in starting to shape what its compliance market is going to be. We already have the ETS, of course, but they're trying to think about how do we integrate removals in the compliance market here in Europe. They're going to publish how they want to do it this year in July. So they're spending a lot of time right now. And they've been looking at what we do in the voluntary carbon market very closely. And so they're taking all the learnings, which means the compliance is going to be even better, which is great, right? But you're totally right. Voluntary first, compliance next, and we definitely need compliance to get to the scale we need.
all right. And I'm gonna sound like I'm being rough with you, but look, rule
I'm
number
used to it,
one.
don't worry.
Rule number one for a VC: don't invest in a startup that relies on regulation. And no, you're telling me that basically the compliance market is what's gonna unlock your model. Um, how should I think about that?
I think two things. So one is, as I mentioned, the voluntary carbon market is huge today, and you can grow just on that for quite some time. So you don't need to expect the regulation to happen tomorrow. It can happen in probably 10 years, you'll still be fine. Good news is for us in Europe, it's more like 5 years. And again, these compliance markets, once they kick in, um, it's not like all the contracts start to get signed when the regulation comes into implementation. All of it gets signed ahead, right? So all the contracts are going to get signed in the next few years. But I think that it's a fair point in the end. If you believe that we should never depend on regulation, then I think you can say goodbye to director capture because we will need strong regulation to get this to scale. But I think if you don't believe in regulation at all, you should say goodbye to climate. Like, it's just, we're not going to solve climate without regulation.
Fair enough. Going back to the voluntary carbon market, does it work only for a company like Microsoft that's doing 80 billion in profit per year? Because it's a rich people's problem, right? Like I have 80 billion coming in every year as profit. Okay, I might invest a few hundreds of millions or a few billions in credits to remove some of my emissions. But if I'm a company that has 1%, profit margin, something like that, then maybe it's more difficult. How do you
Yeah,
think about that?
no, for sure. Yeah. So that's, again, I think a bit in terms of where are we today and where we need to be in the future. Today, it's only the rich that pay, basically, because they have the resources to do it. But it's great. Like, Tesla started with the Roadster, which was a car for the rich. And that was the beachhead. You make money from that, and then you reduce cost and you grow the market, right? And so the idea is that by 2050, the cost of a carbon removal credit should be somewhere around $100 per ton. And that is something that the economy can swallow and can do at large scale. And so that's what's really great about our market, really, is that we know where we need to be. We have a lot of time to get there. 2050 is like a long time from now. But there's already customers willing to pay a high price today so we can get started and we can bring the cost down, right? And it's like tremendous, luck, or I don't know if it's luck, but like good state of the world that we have these tech companies that are willing to put this money on the table. But I would also say it's not, when we talk about the rich are buying, it doesn't have to be a huge company. It's basically any company with a pretty fat margin, right? And so small tech companies as well can do it. Finance companies, financial services companies. Um, like I said, there's like over 700 companies right now that have already signed contracts for carbon removal credits, totaling $12 billion. So the market is huge.
Interesting. You were talking about the cost of carbon removal today. It's obviously much higher than $100 per ton. What is the actual cost that you have today? Where do we stand on that curve?
Yeah,
Right?
yeah. So not $100 per ton. It's more expensive than that. So today, like with our first machine that we've now shipped, like our MVP, if you will, our first commercial machine that is going to produce our first credits, we're around like $800, $900 per ton. Um, and the good news is that actually where we're selling our credits today in the short term. So 2026, we're sold out, and that's the price at which we're selling. And so in the end, you're like, okay, that's pretty good, right? Like you're able to get to the price at which you sell. And then our costs go down drastically. And I can't really tell you what's the story to get to $100 a ton by 2050 because that's so far in the future. Like anything post 2030 for me is sci-fi, and I'm not going to pretend I can predict. But we already have a very clear roadmap to go to $250 per ton by 2030, and that's well within market expectations. Like people expect like 350 maybe by 2030, and so we're pretty good there.
Why would you reduce the price if you're able to sell for $800? Then just do it.
Well, the buyers actually, they will only buy if you show them the cost curve. So,
Okay.
yeah, so when we sell to customers, we show them if you want to buy credits in 2026, this is the cost, 2027, this is the cost, 28, this is the cost, and they want to see the cost come down. Because, part of why they're doing it today is because they know that their climate targets that are public that they need to reach by 2030, for example, heavily depends on these credits. And they don't want to be paying high prices forever. So they're like, yes, we'll pay high prices now, but if it helps you bring the cost down, because we need those costs to go down for us not to get bankrupt if we want to meet our climate targets. But then the other thing is also like it's more than that. Like from their perspective, this is a super supply constrained market. There aren't enough people doing what we do. And so, but they need them. And like, Microsoft, their climate targets are really serious. Same thing, McKinsey, we're also talking to them. They're also very serious about their climate targets. And they kind of need to log these volumes in now if they want to meet those targets. And so the reason why they contract with us is they do, some contract size, but oftentimes they lock in some kind of right to first offer, right to first refusal, so that they have the supply when they'll need it.
So basically, those catalysts are there because they want you to reduce your prices in the long run. They're buying from you now with the hope that you will get the prices down in the future, and then they'll buy even more from you.
Exactly. Yeah. Yeah.
And when we're saying $800 to $900 today, that's full cost, capex and opex included, right?
Yeah. Exactly.
Okay,
Yeah.
makes sense. Um, You were talking about Tesla just before. It's not a surprise to me that you talk about Tesla because you spent 7 years, I
5 years. Yeah.
5 years at Tesla before. It's one of the few industrial startups that really worked, that went to massive scale from zero, which people thought that wouldn't be possible in the automotive industry. What have you learned from that experience that makes you better qualify for the carbon credit, or I mean the direct air capture market?
Hmm. Yeah. I mean, it's a good question. I've been thinking about this a lot. I think if you look at how Tesla works, um, so much focus is on speed of iteration. Just how quickly are you able to build something, learn from it, improve it, and just iterate as quickly as you can. And so, for example, one of the things they do at Tesla is they don't build a new version of the car every year or every 2 years. Instead, they continuously update the cars on the line. And so if the heat pump system is ready, they will upgrade the car so that all new cars coming out of the line have a new heat pump. Um, and so all of these small things get added on top of each other all the time. And I think if you take a step back and you look at Elon's background, he was in software before building Tesla. And basically, it's applying all of the best practices of software to the hardware space. And I just realized actually recently that I have the same background, of course. I was a software engineer before this. And so I think that's why this approach to hardware really resonated with me. And I was ready to go and do the same thing. But so it's, yeah, ship as quickly as you can, right? And then learn from that and then iterate, and iterate as fast as you can. The faster you iterate, the faster you can improve your products and the faster you can reduce your cost.
But it's not what other people have done in that industry. I mean, I'm thinking about Climeworks. They've went ahead and built like this full scale kind of first
Yeah.
plant, which was a massive plant. How do you not do that?
Yeah. And so, for example, I mean, and I love Climeworks. Like they've de-risked the technology, for the whole space. They pretty much created the industry because without them, I don't think that people would believe it would be possible. Um, but I think they basically scaled up too quickly without iterating fast enough. And so what we understand is that some of the issues they had in their initial plants, they just basically translated to the bigger plants without fixing them. And so they're in a situation which is where they are right now, which is their larger plant isn't really working as expected, and they've kind of stopped development of it. And so it's again this rapid iteration, and I think also from my perspective, it's sort of the required intensity to be successful in hardware, and that's really something that I learned also from my time at Tesla. Is just the sheer amount of sweat you need to put in to be successful in hardware, and just making sure we have the same level of dedication in the team we have.
And I guess that's a good time to talk about the technology because you've done some interesting choices along the line. One of them is that you have a modular plant. So something that you can scale. The way I kind of put it in my mind is like you have different containers that you can just put next to each other to scale it. Is that part of the reason why you're thinking through it as, all right, I want to make it so that I can iterate really fast. And as such, I want to make small units that I can scale by just adding more units. Is that the way to think
Yeah,
about it?
exactly. So the really that's really the core of the DNA. It's like speed of execution, speed of iteration in the team. And so everything we do is how do we improve is about how do we improve the speed of iteration. Um, and it's much easier and much faster to iterate on a plug and play modular system than on a huge industrial plant. If you build a huge industrial plant, you can only iterate every time you build a new plant. We can iterate every time we build a new container. And
What's the pace at which you're building new container, producing new
yeah, so
containers?
so the company now is close to 3 years old, and we're building our seventh machine. Um, Obviously, in the beginning, I think we were able to iterate extremely quickly. Like every few months, we had a new machine that was bigger and better. Now, when we're building these huge shipping containers, we're basically iterating every 6 months. So every 6 months, we have a new version um, that's that's better, lower capex, lower opex, everything you can imagine. And just to bring it back to you really see it's very salient when you look at Climeworks because of course, they actually use these big plants model. Probably indeed, influenced by people who had worked in industry in the past, and you said, no, this is the only way to do it. But it's the way to do it once your technology is mature, maybe. Um, in our case, not the case yet. It's all about reducing costs, all about learning. It's all about de-risking, fixing issues. And so, yeah, by building these modular systems, we're able to learn much quicker and fix the problems before we build bigger systems.
Makes sense. You, as we're talking about the technology, one of the choices you've made as well is having solid sorbent is the way you capture carbon. There are a lot of different other approaches. Why is this one better when we think about direct air capture?
Yeah, I think it was very confusing for a lot of VCs. It's like, how do I figure out which of these is the best? I have no clue, right? Everybody's telling me their tech is better. Um, the reason why we picked solid solvents is exactly for what we've been talking about just before, which is it's um, it's a pathway for direct air capture where you're able to build something in a small modular plug and play system. If you were to build uh, a liquid solvent direct air capture company, like we have with Carbon Engineering, which became Oxy in the US, the only way you can make it economical is to build massive, massive plants. And which is why their first commercial plant is like a $2 billion capex project. which is nuts. And it also means they can only iterate every, I don't know, like 5 to 10 years even for them.
As a
Um,
comparison, how much was your first plant?
yeah, our first site right now that's running in the Middle East, I think total cost perhaps like a million and a half. Yeah, so like very different, right? And so indeed, it's also allows us to get to market much quicker because now we can deliver value, we can deliver credits, and especially in an industry where these companies are constantly being delayed and aren't delivering the value that they promised they would deliver. I think buyers of carbon credits are really looking to who is actually delivering now, right? And who has the path to de-risk large scale delivery. And it's going to be the ones who've already built systems that are proven, and scaling up just means building more of the same systems,
Mhm.
right?
When I think about this industry and how it could go forward, one of the questions I ask myself is it possible that there is more innovation down the line on the solvent itself, kind of a Moore's law for solvent, if you will, so that we get better every year? And at the end, what we are building today basically is irrelevant in 2 years, 3 years, 5 years from now. How do you think about that?
Yeah. So I mean, just to get back, like solid solvents, like the modular side is really one of the great aspects. I think more generally, if I look at why we pick solid solvents, it's the main reason at the top is because we think it has the steepest learning curve, meaning we think it's the technology pathway for DAC that will go down the cost curve the fastest. And that's really what we need to unlock this even larger market, right? The fact that we can build modular systems in a manufacturing line is a big piece of that. The other part is that it allows us to build also very simple systems. So if you look at our containers, there are very few moving pieces, which means we can also reduce the cost pretty rapidly. Um, and then the other aspect, which goes to your question, is we are seeing enormous amounts of innovation happening at the material level, where there's now such a strong incentive for companies to build better materials for direct air capture because the market is going to be so big. Um, and one way for us to ride that wave of cost reduction is to build machines that are agnostic of the solvent. So we work with solid solvents, but there are many different kinds of solid solvents: MOFs, zeolites, amines, but also on the substrate, cordialized, some kind of polymers. A lot of suppliers send us materials. We don't even know what it is. They don't tell us, right? And we're seeing so much innovation here that we want to build machines that are agnostic of the solvent, which means we can always use the best solvent available to the market and use that in our machines. So that's great for the first solvent you put in your machine. But the second aspect is, wait a minute, as solvent gets better over time, can I maybe also replace the solvent in my existing CapEx? Because you're very right. Like the machines that Climeworks has right now, they're kind of stuck with the solvent they have. In our case, it's extremely easy to replace the solvents. And so we keep the door open. If the better material comes in the future and that the OPEX reduction is so drastic, for example, that it's worth buying more solvent to put it in, then we will do that.
Okay, I love the approach. Um, when you look at the news in direct air capture, and at the people that are, I wouldn't say against it, but quite skeptic of the idea. One of the topic that comes back often is, does it really remove carbon or creates more that it absorb, basically, right? Because one of the biggest challenge that you have is basically you have input in, which is electricity or energy, and then you capture carbon. But if your electricity produces more carbon than what you've captured, your operation is net negative. Um, how do you think about that today? Is that like, have you run like a full analysis to make sure that this is not happening for you?
Yeah, of course. I mean, from the get go. So my yeah, my co-founder is a like PhD in thermodynamics, and he's like very intense about climate, like I am. But I think he from the beginning had to verify, is this ever going to make sense, right? And I think that's where the folks like Climeworks have been very useful, is that they've shown to the world that this is possible. And they were the first one to do a proper LCA, based on their existing site and publish that on Nature, and showing that indeed very quickly you can get to like 90% carbon removal efficiency, which means that for every 10 tons you capture, you only emit one in your process. And that's also what we're seeing in our models now. And so And at the sites that we have, we can stress test these models. And so we can actually see, okay, with all of the activities we've done here, how much CO2 are we actually emitting? How much are we capturing? How many credits are we actually going to be able to sell? And then we can see the bottlenecks, where are most of the emissions. We can work on those and reduce that, which is why we really believe that to work on the right problems, you have to build something in the real world, deliver real credits so that you learn the real challenges. And so we're stress testing these models now with the real world, but it's looking pretty good. It looks like indeed, like this technology can remove way more CO2 emissions than it emits.
But what does it take? Because I would assume that if you power it with coal or
Yeah,
gas, right?
yeah,
So
of
what does it
course.
take for it to work?
Clean energy, of
Clean
course.
energy.
Yeah, so it's super energy hungry technology, but as long as you have clean energy, you're good to go. The good news is that that's where the world is going, right? Like renewable energy is taking over the world. So think about 2050, it's going to be a world of abundance of clean energy everywhere, right? And perhaps maybe not like everywhere, like maybe not in the center of Manhattan, where it's still going to be like energy constraints, but there's going to be plenty of places in the middle of nowhere where there's going to be a lot of clean energy that you can build. Um, and the benefit of direct air capture is you don't have to be in the center of Manhattan. You can be in the middle of nowhere because the CO2 in the air is super well distributed.
Does that affect your choices in terms of geography?
Yeah, for sure. Exactly. And so I was talking about the long term. Long term is abundance of renewable energy everywhere. And a good critic will say, indeed, like, is that the case today? So why are you building your machine now? And I will say, well, there are places in the world today where there is an abundance of renewable energy, and that's where we want to go. So, for example, we had our first pilot plant in Kenya. Kenya has like abundance of renewable energy, like 90% renewable on the grid. And today we're in the Middle East where we have abundance of solar energy. And then next we're looking at Norway, which has an abundance of hydro energy, right? And so you just want to make sure you go to the right places because indeed, otherwise, I think the next step critic will say you're stealing renewable energy that could be used for something else. And so you want to make sure that you're in a place where there is abundance of it, or you're building new renewables for your own project.
So you're basically saying it's not an easy equation because you have to be in a places that has a lot of abundant clean energy that is not being used for any other use cases, and that is abundant enough for you to work with,
Yeah, and
um,
it's cheap.
and it's cheap for it
Yeah,
to work. What's the price at which energy cost works for you economically?
yeah. I mean, today, I mean, let's look at what's available actually. But uh, Canada, Norway, hydro is like 5, 6 cents a kilowatt hour on the grid,
Okay.
24/7.
Okay.
And you can just go now and hook up if you want. So it's pretty crazy. Like go to right places and you'll find the right energy. I think long term, um, again, this is also one of the reasons why I when I did my early models when I was trying to figure out what to build in climate, it just was clear to me that in the long term, the energy consumption of DAC is not really a problem because so look like we're aiming for, something like 1,500 kilowatt hours per ton on energy electricity per ton. But you're thinking 20, so now at 5 cents a kilowatt hour on the grid, that's $75 per ton for energy, which is really reasonable when the market expectations by 2030 are, $350 per ton. But if you look longer term, when we're thinking about hitting that $100 per ton in 2050, if you have energy at like 1 or 2 cents a kilowatt hour, we're talking, 15 to $30 per ton for energy. Again, pretty reasonable. And you can, realistically hit your $100 per ton target there.
What's the structure of today's cost and the future cost of credit? Like, you don't have to say where your margin is, but at least, from
Yeah.
an idea perspective, how much is energy, how much is your capex, how
Yeah.
that goes together.
Yeah. Today it's mostly OPEX, so mostly energy.
Okay.
Um, and then that drastically goes down with our tech roadmap. Like we have a bunch of things happening, like integration of heat pumps and heat recovery and all of that, which are really going to help. Um, and then it's capex and it's solvent.
You were talking about the site location or site selection. A trend that's not going in your favor right now, I believe, is data center. You can basically put a data center anywhere in the world. those people are angry for money. By the way, it's funny enough, those are the same people that are paying you for the removal that are
Yeah.
also building data center. How do you see that going in terms of like finding basically locations where it's not disrupting anyone? There's clean, abundant energy and cheap energy, which seems like the perfect case for a data center. How do you see that going?
Yeah. So I think on one end, indeed, it's like a boon for the market because it's like Microsoft who's needs to meet their targets, and they're like, how do we get there amid increasing emissions? Just means they're going to buy more credits. Good news is they have the profits to do that. So and they're not they're pretty adamant at following their strategy. Um, I agree with you though that there is a clash between going and finding the energy, especially in places like the US, where it's been the most harsh. And I think that's part of the reason why a lot of the companies in the US that are doing direct air capture are kind of screwed. And they're not in the US anymore. They're all moving to Canada. Um, so I think it is real. I think the other thing, it's not exactly correct to say that data centers are going to be looking for cheap energy. Actually, they don't really care. Like most of the cost of data center is going to be the chips. And so the energy, even if it's super expensive, they just don't care. Right now, it's all about how do I bring on more compute over time. Um, but uh, but indeed, it's going to come to Europe. I mean, OpenAI announced like a big data center in Norway. We were looking at the interconnection queue, and they're basically taking an existing data center that already had energy that was reserved for them on the grid. So they're not adding more load. Um,
Not yet.
and not yet, yeah. Um, One thing that's interesting with data centers is that they're also it's very important for them to have high security around their premises. And so we see, for example, that they're not very excited about building data centers in Kenya, uh, which is an opportunity for us. We might say, okay, well, you don't go to Kenya, that's going to be where we're going to scale, for example, right? So we have options. That's one of the things we've learned also is as we move from building the technology to actually building projects out in the real world, is realize that project development may be the hardest part of the business because there's so many external things you don't control. And so it's been very important for us to diversify our project portfolio
Mhm.
and to look at multiple places at the same time, continue to push very hard on all of them so that if one of them stalls for one particular reason, you can always continue to scale at the others. And so you're not slowed down or bottlenecked by the speed of how quickly you can speed up the machines because you always have one you can grow.
Makes sense. Um, when we think about CO2, it's this invisible molecule that's in the air. It's all around us. You're telling me you're capturing it. What do you do with it? How can I prove it?
Yeah. So in our industry, there's really two paths. Like one is you put the CO2 on the ground and then you sell carbon credits to companies, right, that want to get to net zero. The other path is, and it's very easy because you just have a sensor that measures how much CO2 is going through your pipe and how much CO2 is going underneath. The other path is you can use the CO2, actually, you can do stuff with it. You can put it in construction material, you can make fuels from it. Um, and that's interesting. Although the volumes in this market are going to be much smaller than the carbon removal market, and it's not even less mature today. And so we're very focused on carbon removal, which is putting the CO2 on the ground.
How do you ensure that it's not, you know, going back again? It's in the atmosphere. And what's the probability that it goes out within the next 5 years or 10 years? Or like, what do you promise to customer in terms of duration?
Yeah, so we promise, I think 1,000 year plus is what the registry that we work with promises. In practice, the storage that we are using is geological scale, meaning the CO2 that we inject on the ground is going to be turned into rock itself. So the CO2, we inject it on the ground in a well, say 800 meters deep, into this porous geology, porous rock. The CO2 permeates the rock, and the rock reacts with the CO2 to turn the CO2 into minerals, like calcium carbonate, silicon carbonates, which means that's just going to stay down there for, pretty much ever, unless like some volcano comes around or whatever, but like it's pretty much ever. So, and then the way you prove that is you build these monitoring wells. So you inject CO2 on one end, and then you build another well over there, and then you see what happens to the plume of CO2. And then eventually you can even just take a sample and see that indeed the rock is full of minerals now. And it happens pretty quickly. So the folks in Iceland that do that, they were able to show, I think, 90% mineralization after just 2 years. Our partners in the Middle East, I think they were able to show like 80 something percent after 45 days. And so it's actually quite fast. And so once it's rock, you're safe and it's safe.
Is that something that we know how to do well, which is like drilling 800 meters plus and then injecting CO2? Is that something that we do well already today?
In some places of the world, in the places where they've already been drilling. And so, for example, that's why Kenya is such a great place also, because they have an existing geothermal industry where they're used to drilling wells, 3,000 meters deep. Middle East, of course, they also know how to drill. And so our partners there have been able to leverage that expertise. Um, and then Norway is the same. Norway, they have Equinor, who's oil and gas. And so actually the well that Northern Lights, which is the storage project in the North Sea, has drilled is 100 kilometers offshore, and it's 3,600 meters under the seabed. It's just insane to imagine. And actually, when you look at it, it's not a very big hole. It's like, it's big.
Yeah.
But it just goes really, really deep.
Makes sense. You were talking about the oil and gas industry. I think one of the famous and most valuable exit in this industry was to an oil and gas company. How do you think about that from a climate perspective?
Well, the first thing I would say is like, this is great because I know you have VC auditors, well, not auditors, but like people who listen to the podcast. Yeah. Is that interestingly, DAC is one of the only verticals in climate with strong exits because the energy companies are so interested in this space. And so, but it's interesting. Yeah. Like, so, you have two camps basically, right? In climate, the folks who believe that oil and gas companies are only doing this so that they can continue polluting more, right? And then the other camp that says, no, we need oil and gas to be able to scale this. I think like I don't think both. I don't think it's one of those actually. To some extent, oil and gas, they can't really hide behind this kind of greenwashing for very long. They're going to be displaced by renewable energy no matter what, right? And on the other side, are they really the ones who are going to help scale this? I'm also not sure because it's so fundamentally different and opposite to their existing business model. Like one business model wants to see carbon credit prices be low, and the other wants to see credit prices be high. So I don't know how they're going to reconcile that. Um, but in any case, if they bring capital to the industry and help us scale, I think it's welcome. Indeed, we'll just have to be very careful that they don't use it as a greenwashing screen. But I don't think that it's really possible for them to protect them very long anyways.
Talking about this assumption that carbon removal could be indeed a solution that allows companies to continue emitting more CO2 so that they can just basically buy their way out of reducing their emissions. What's your stand on that?
Yeah. So sometimes people will think that, well, you're just telling people they can stop emitting, they can stop producing emissions, or the people who buy your credits are not reducing anymore; they're just buying your credits. Well, the thing is, like, our credits are really expensive, so it's not a very good strategy. You would rather reduce emissions because it's cheaper right now to do than buying our credits. So,
What happens in 2050 when it's $100 per ton?
but in 2050, when it's cheap enough to remove CO2 from the air, then I say, go ahead. You know, I much prefer actually that you buy 1 ton of carbon removal from me for $100 a ton than you try to remove or avoid 500 kilos for the same price. Because the impact on climate is going to be much better with the capital efficient way to have the impact on climate, right? And so I think that's the role that we play is at some point, the curves cross where it becomes cheaper to remove CO2 than to avoid. And it's going to be different for different people because different companies have different value chains, etc. But that's where we are. Like, and that's why the market is there today. Also, right? Like, it's these these tech companies, they don't know what else to do. They're already using renewable energy everywhere, um, and they're still flying, and they don't know what to do with their flights. So they're still building data centers, and they don't know what to do about cement. There are no solutions, or they're too expensive, or more expensive than what we provide. And so we then become the most capital efficient way to have an impact on climate.
Mm-hmm.
So I think it's good.
One of my VC friends that I really look up to told me once that you should invest in companies that can sell to climate deniers. Um, when I listen to what we've been talking about so far in this episode, I'm like, man, like this is only going to sell to people that believe in climate change, which those that don't are frankly quite dumb. But still, like you're going to sell only to people that care about it, or is that a misunderstanding of the situation?
I think the voluntary carbon market, that's close to the situation. I think in practice, they also think about it very rationally in terms of, hey, employee retention, it looks good, and I get my employees to feel a bit better if I tell them that all their flights are compensated with durable carbon removal. Um, Positioning in the market, they might get more deals, more business if they are a sustainability firm in their field. Um, but it does usually come with some leadership that is pretty convinced that this is the right thing to do, or that over time this is necessary for them to have a social license to operate in our world. Um, but in practice, as I said, we need to graduate to compliance markets where it's no longer how do you feel about it, but it's you have to do it. Same way that you have to pay the municipality to take your trash. You're gonna have to pay for the CO2 you emit.
That's
It's okay.
it's a good way of putting it together. Um, Good. Tell me about your progress so far. I think you've been quite, or you've impressed me at least as the speed at which you delivered revenue. Um, I wonder what you can share on that. And the in the back of my mind, there is also going back to this modular thing. I looked up the numbers for Climeworks. They have raised about 900 million so far. Do
I
you
think
need
it's close
as
to $1 billion, yeah.
close to 1 billion? Do you need that much money? Like these are the two stuff that I'd like to cover. So let's first start with the speed of execution. How many credits have you sold so far? As you delivered? Because I think there's also time between selling and delivery. How does that work?
Yeah. So, I mean, that's what we were all about from the get-go, right? As I mentioned, it's all about speed of execution. Um, and so we're very proud now, actually, that indeed we're the fastest DAC company to have deployed a commercial site. So we went from company inception in February 2023 to a commercial site running in the Middle East in October of 2025, right? So less than 3 years, which is fantastic, and just shows that indeed we've been able to build a team that can execute here. Um, and how do we do it? It's just rapid iteration and just a lot of, I mean, actually, no, it's not a lot of people. One of the big things I learned at Tesla was that you can do much more and much faster with a lean team of exceptional people. And so actually you want to have the fewest amount of people so that you can move the quickest. Um, so I think that's a big part of how we were able to get there. Um, and then when we go to your question around, do we need to raise that much money? I don't think so. It's also one of the things I learned at Tesla is you can do so much by being extremely scrappy. A lot of times, actually, fast and cheap converge. So, for example, like
Time is money.
you want to buy, for example, a steam accumulator. Okay, it's like this big container where you can accumulate steam inside, and we need that to be able to do very short bursts of steam. Um, and you want to go on the market, you want to buy one. It's like 100,000 euros. It's like, oof, that's expensive. And I look at my engineers, and I'm like, fundamentally, this is a pretty simple system, right? It's going to be a container where we put gas inside. It's like, can we find a cheaper way to do this? And then they come back next week and they say, we thought about something. There are these things called milk tanks, and they're kind of the same. And we can buy a milk tank for maybe 10K, and we can do modifications on it for a few $1,000s with some welding, and we get to the same result. It's like, there you go. And lead time is a few weeks instead of 4 months.
Mhm.
All right, cheap and speed, right? At the same time. So I think that's you go fast and you're able to do a lot with a very small amount of money. So we're extremely DIY and how can we build our test benches and our prototypes and our machines, what we can find around us. Um, and if you look at, for example, SpaceX is now valued as like $1.5 trillion. And if you look at how much they've only raised $12 billion. And of course, that's more than $1 billion. So to answer your question, but also SpaceX is insane as a company and like extremely much more complicated like than what we do with director capture. And
Oh,
so,
and you know, I'll give you 12 billion if you tell me that your valuation is going to be
yeah,
1.5
first
trillion.
is you can
I don't
be
mind.
extremely capital efficient for and like a really great return story for investors.
Mhm.
But then second, indeed, like building what we build, extremely simple machines, very few moving pieces. We're going to be able to do enormous amounts with much smaller amounts of capital than that. I think we're not expecting to raise much more than $100 million in total over the lifetime of the company. And this is definitely going to become, billion dollar company, given the size of the market.
And so you want to become a $1 billion company.
I don't know if that's the goal. I mean, my goal is to have an impact on climate.
Mhm.
But
What's the impact on climate that you can have at scale once you
yeah,
reach the goal?
yeah. The again, looking back at the big picture, 40 gigatons that we emit in the air today, we need to remove 10 gigatons of CO2 from the air. How many companies are going to do that? It's probably going to be a bunch of different companies. Like I said, I think it's probably going to be closer to oil and gas, where you're going to have a number of massive companies that are going to do this. Um, but going back to what we were just saying is that, anyways, the only way that we get to that is if we make people rich in the meantime, because that's how we're going to get the capital to build what we want. And so, um, for me, it's really marrying the two things of one, climate impact, with how do we make a successful business that will drive tremendous investor returns, um, in making that the story. And so the goal is to have the biggest climate impact, and how we build the business, it means necessarily that we will become $1 billion company and like take $100 million company.
Love that. So that's a 10 years or plus vision. Um, Look, one last question for today, and we'll probably end up on that. Maybe on a positive note after that. But what could go wrong in the meantime? What are the risks before you get there?
What could go wrong? um, it's a good question. I mean, yeah, you realize when you start a company that so many things need to happen in parallel, and it's always chicken and egg problems everywhere, right? And so you have to gradually climb that ladder of credibility with the amount of money you have to get more credibility, to get more money, etc. And and more money doesn't have to be, because also the other thing is we were talking about raising money at the topco, but most of the scale we're going to get to is going to be debt financed, right? So non-dilutive for VC investors. Um, and so what could go wrong? We need the market to continue to grow, as it's been growing. So that's on a good path. We need compliance to arrive, which is on a good path. We have a lot of touch points with folks at the commission, and it's going to happen, which is really exciting. But it's also having all the right pools of capital excited at the right time, right? Be it VC capital in the beginning when there's the most risk, to infra capital, debt capital, and then how do you bridge that gap? So I think all of these things need to happen. And then it's on the project development side, just making sure that you're starting everything ahead of time so that you can deploy your machines at scale when you'll be ready to build them. And so just making sure everything happens at the same time in sync, because if you're behind on one or two, your business is not going to work.
All right. Well, on a more positive note, how can we help you get there?
Um, how can you help me get there? I think sharing the story is a great way. I think people sometimes have, can misunderstand the markets. They don't really understand how come there's a $12 billion market right now, and why are people buying. And I think is helping understand that why they're doing it and that this market is real is important. And then indeed raising awareness that actually Europe is perhaps the best place to do director capture because of the strong compliance market that is coming. And even if things are slow in Europe, like Macron says, is that once policy is there, it is there to stay, right? For sure.
I love that.
So
We'll end up on that. Thank you so much for today. The thing I'll say is director capture raises a lot of fundamental questions, but I think and I hope that today we have answered a few of them. Thank you for being courageous also to answer some of the more critiques that I had on the model. If people want to reach out to you, corporate talents, customers, VCs, whoever, what's the best way to get in touch?
yeah, I mean, either LinkedIn, add me on LinkedIn, Thor Gutierrez. You'll find it in the show notes, I'm sure.
Yeah.
Or my email is thor@sirona.tech.
Perfect. And then obviously people can reach out to me and be happy to do an introduction. And who should be in your seat next? An entrepreneur that's moving the needle for climate. Who should that be?
Yeah, it's a good question. I think to get the other side of the story, so we're removing CO2 from the air. If you want to talk to someone who's removing CO2 from flue gas, so from point source emissions, you could be talking to Samuel Thierry, who's building ARC capture solutions in Belgium. And he's moving pretty quickly too.
Great. And listeners, if you like this episode and if you like the show, don't forget to like, comment, and subscribe if you're on YouTube, or to give us a follow and a 5-star review on Apple Podcasts and Spotify so that we can get more amazing guests like today. Thank you so much, Thor.
Awesome. Thank you.